Quiz time. What do the last 4 NFP prints have in common? Each of these weeks saw realized volatility pop above 20%. On its own, I give you that, not a big deal. But since June 1st, we've only had 4 sessions where realized volatility went above 20%, and that is less than 5% of the total of the session. So needless to say, it's been pretty quiet, stark contrast to the period where you had all the tariff shenanigans. So back to those 4 sessions where we had 20% plus daily realized volatility. When did they happen exactly? So you had one in an FOMC day on June 13th. So that happens, no big deal. But then the other 3, they all happened during NFP weeks. June 6th, we saw 22%. August 1st, we saw 23%. And then September 2nd, we saw 24%. And which week is it now? Well, you now see where this is going. Because this is the first week of October, and obviously we're going to see an NFP. There are some talks about government shutdown, so maybe we might not even see the NFP. But needless to say, maybe things might be brewing more than what we see right now in the price. And let's see what our volatility forecasts say. We wrote in our last signal du jour mid last week that volatility in AWM was overpriced, and at the time we had a nice 70% chance to see IV sold today exceed the subsequent realized volatility. Now, needless to say, that probability is back in flip of a coin territory. We don't want to have anything to do with it, and in fact we also realized yesterday that the trade is at profit target, so getting out is probably the right thing to do. But overall, this is what we see right now at the 30-day horizon. The 9-day horizon is giving a completely different picture. And you see that the probability to see IV sold today exceeded by subsequent realized volatility, flashing in all 3 major indices, 73% in IWM, 69% in SPY, and to a lesser extent, 63% in the Qs. So what do we do with this? Well, first of all, we do not panic. So when we wrote that article last week, the probability indeed was at around 70%. We are at 45%. Again, that's at 30 DTs. You know, it's probably best to get out, right? We never know what's going to happen. You can keep it, but not the most optimal thing to do. At 9 days, what we're basically saying right now is indeed we were hesitating for a few days, and now the signal is quite strong. And one of the most important feature that we are pointing out in the model is saying that right now the implied volatility measured in the very short DTs, 9 days, is quite low. The Z-score is compressed, and something might be brewing. You see a very similar picture in SPY. Implied volatility is very likely to increase. The VRP right now is also likely to increase. So basically, implied that you sell today is likely to get exceeded by subsequent realized volatility. And what we point towards is the same kind of insight. Something else for the potential expansion of implied volatility is the contango we observe right now in the term structure is extremely steep, and therefore it is worth paying attention to it and expect a little bit of potentially flattening over the next days. I insist on that. We are by no means trying to say that something major is going to happen. Now, maybe the catalysts over the next few days are going to show that the job market is indeed very tense, or the government shutdown actually stays longer than what people were originally anticipated, and then realized volatility drastically go up from there. But right now, that's not the case. We expect realized volatility to go higher than what it is right now, but nothing substantial. But still, right, if you have a big bad day, the same type of bad days that has happened the last few months in September, in June, and in August, how do you prepare for it, and how ultimately do you try to structure a trade around it? So one thing to take into consideration right now is that spot vol in IWM is actually Still negative, right, at 0.58, but we're very far off the lows that we've seen during obviously the tariff war, right? And then we have gradually come off the lows. So it's more a market that shows that it's not too concerned about the move to the downside and a little bit less willing to pay expensive insurance premium to hedge those movements. But again, at the same time, if something happens tomorrow, we want to be able to at least be hedged and then potentially have something in the book that will help us benefit from it. So what is this going to look like? Well, before moving on to the volatility surface, let's have a look at the more obvious and easier sometimes to interpret VIX term structure. As we can see, the volatility in the very short term is quite low. The contango is well pronounced, and basically what we can expect is we see the short term reprice, so flattening of that curve in the short term here, and that's actually what we're trying to capture, right? Actually, if we can get some trades where we would be long this part of the curve and we'd be short that part of the curve, that would align with our thesis. What we're saying is in the short term something can happen, but overall the long-term market expectation of implied volatility are well anchored, and what is going to end up happening. So selling, implied volatility at 2 months, 3 months, and then try to see if you could use that to finance some short-term options could be a good strategy. Now let's move on to the volatility surface to see where we pick up exactly. If we plot the volatility surface and we plot realized volatility against each of the tenor, we can get the variance risk premium. We take implied volatility in each of those nodes and subtract the realized volatility. It's not the cleanest way of doing it, but it's a good benchmark and it works. And then we build a Z-score in all of those nodes against themselves, right? Taking history over the last 3 months. And that's how you end up seeing, for instance, that at 10 days and for the 40 delta put, right now the Z-score is quite compressed, minus 125. And if you compare that to much longer expiries, at the money 49 DTs, you still have a decent bit of VRP, right? It's not amazing, but 0.6 shows that like there is a little something. And that's basically what we're going to try to do here. As much as possible, you want to try to sell options in these bands here, and particularly on the put side, because they tend to be more expensive. And then you can use the premium that you're going to collect here to buy something here. Now, the big mistake that we often see online is people do it premium to premium. That's not how you want to do it. You want as much as possible to do it Vega neutral. So every Vega that you are going to collect at 49 DTs needs to be reused to basically buy some Vega in the shorter DTs. So Vega here is obviously going to be a little bit larger than this one. So to take a concrete example, let's say that you sell one option here and that you collect 5 Vega, and that the option here, the Vega is 1. It means you need to buy 5 of those options here against one of those options there, and bet for that term structure contango to flatten a little bit over the next few days. It's a good way of doing it because at least you're less exposed to theta and bleed if nothing happens, right? Because you collect a little bit of something here and then you basically reinvest it in there. And if nothing's happened, well, then you just throw the position away. That's it for now. As usual, do not hesitate to leave some question in the comments, interact with us in the newsletter, and until next time.